moving into real estate, today we have with management of BSR REIT, an owner and operator of multifamily apartment properties in the US Sunbelt. The ticker is HOM.U on the TSX. Since their 2018 IPO, the REIT has completed a transformational capital recycling program, including approximately $900 million of acquisitions and $600 million of dispositions, and currently on a portfolio in excess of $1 billion, concentrated in markets with some of the lowest unemployment rates, highest employment growth, and highest population growth in the U.S. We're particularly happy to have them with us today in advance of the presentation later today at the 2021 REIT Conference, where they'll be sharing their story with more than 3,000 investors, executives, and professionals. So with that, I'll turn it over to John, Susie, and Ben. Thank you, guys.
David, thank you for and Echelon for having BSR REIT and giving us a chance today to tell a little bit about our story and why we're so excited for our company and our prospects going forward. I'd like to introduce or allow our team to introduce ourselves quickly. If Susie, if you would, and then Dan, and then I will, with a little bit of color on the history of the company and where we are and where we got to today. Susie, you want to start with the introduction?
Sure, absolutely. Again, my name is Susie Kane. I am the Chief Financial Officer of BSR REIT. I joined BSR in December of 2013. Previous to that, I worked for EDR, which is a collegiate house that was traded on the New York Stock Exchange, and I began my career at PricewaterhouseCoopers. So I've been at BSR for about 7.5 years now. And we've had a lot of activity that goes with the first paying off our private equity to the spinoff of our affordable housing up to our listing on the TSX, and then turning around and recycling 75% of our portfolio, which we will tell you all about today. And with that, I will hand it over to Dan to introduce himself.
Hello, everyone. I'm Dan Oberstein. I'm president of the company. I come from a legal and acquisition background, both within the company and its predecessors. Recently, and I think that some of you may know that we executed what I would say a pretty efficient capital recycling plan in the last 3 years, whereby we sold around 38 properties and bought around 18. And prior to that, we became public on the exchange in 19, off the backs of really conducting a rather substantial capital redevelopment plan consisting of roughly $50 to $60 million of capital investment in our portfolio and suite upgrades and property upgrades. So those departments of acquisitions, dispositions, asset management, market surveillance, that's where my background comes from.
Thank you, Dan. And my name is John Bailey, and I am CEO of BSR REIT and have been for the last 30 years. I'll say I got into this business rather honestly. Both my mother and dad, my late mother and dad, started this company back in 1956. And it wasn't until 1991, after I had been trading as a floor trader at the Chicago Mercantile Exchange, trading Eurodollar futures, that my mother was retiring from this business, and it was a perfect time to take my family, move back to Little Rock, and begin investing in primarily apartments. Over the years, I guess from 1991 until the end of year 2012, we had accumulated 4,400 apartment suites. And that was at the time that we merged in with another company out of Montgomery, Alabama, Summit Housing Partners, and my partner Daniel Hughes. And at that point in time, we had a total of 8,400 suites, market rate suites. And as Susie alluded to, there was an affordable portfolio that had come in and bolted on alongside with Daniel Hughes's market rate suites. And what we did is we sold and monetized a good bit of that portfolio and bifurcated that piece of the company. And we monetized about $32 million. And what we did with that money is that we were going to take that back and do value add projects, into the interiors of our suites, doing upgrades, as well as improving the amenities that we were offering on our properties, with the objective to increase rents and occupancy. And just as a testimony to what happened by the year end at year end 2015, all the way going into the second quarter of 2019, the NOI of the properties that we owned of the same store increased by 30%. It was quite a very successful venture. When we went public on the TSX in 2018, we were in the midst of completing and undertaking the program of value add projects, and BSR became known somewhat as a value add player of multifamily B-class assets in the mid part of the mid-central region of the United States. We're located in 3 different states right now in the United States, which is in the Sunbelt, but that's Texas, Arkansas, and if you wouldn't mind going to slide 5 with me, please, David, so that so you can see that it's Texas, Arkansas, and Oklahoma. And we own and manage about 7,660 suites. You know, in the beginning, when we went public in 2018, we had 14 different markets that we were in. Today, we're in 5 suburban areas of the primary and secondary markets of Austin, Houston, Dallas-Fort Worth, Oklahoma City, and Little Rock, Arkansas. All of the rest of the cities and locations we had told the market we were going to sell and continue executing a rotation strategy. As what we saw shortly after we went public, about 6 months after we went public, was that we had a tremendous compression of cap rates. So the values went up tremendously in the secondary markets compared to the primary markets at a level that I haven't seen in my lifetime. And so we took advantage of that for our shareholders and actually sold all of these assets that Dan had alluded to before, in taking this transformation of this company and extracting an extra 10% more than what we had put those assets into the REIT for. And we rotated that capital and put it to the primary markets of Dallas, Houston, and Austin. So this is why we're just in 5 markets. And why did we go there? We did it with a discernful strategy of understanding that this is where the highest growth has been predicted over the next 5 years. And I'll tell you, from my lifetime in the Texas markets, they consistently grown faster than the national average. And we've seen over this past year a tremendous amount of growth that has happened with not only people moving out of these large states and northern states that have had shutdowns, but they've come down because of the business environment being so open and the regulations being so, I'll say, available for businesses to operate. So we do have a tremendous amount of runway. We've been seeing some tremendous traction in our rental growth. As for an example, right now, as if you want to talk about the month of May, on all of our new leases, we've been experiencing 8% rental growth. And for I'll just say on the renewals of our leases, it's been at 3% for a combined average of close to 6%, which is very phenomenal. We've seen this continue to step up, as April was a little bit below that on the combination. So we didn't think that this traction would take hold of coming out of this pandemic until the second half of the year. But what we're seeing is Texas and these markets being open, that we're seeing a tremendous amount of business activity, rental growth, and I would say overall income growth for all of our middle income cohort. So please turn with me to page 6. Just to give you a little bit of context about what our garden style assets look like. They are very low density rental communities. They're typically situated maybe on 20 acres of land, maybe having 15, 20 buildings. And they're typically 2 to 3 stories high, with maybe up to 16 units in each one of the buildings. And so there is a very much of a higher lifestyle of a resident that could take advantage of all the amenities that we might have either put on the site, or we may have purchased the property with them. For instance, dog parks. And if you want to talk about grilling stations, the swimming pools, even some running trails that have been on some of our assets. And of course, the fitness centers are pretty much of the lifestyle that our residents, the younger type of cohort that are living on our properties, which are middle income cohort resident, making about average of 60,000 US per year, have really taken advantage of the very affordable apartment communities that we own. If you wouldn't mind turn the page to page 7. You know, just from a standpoint of the investment highlights, we do, Daniel Hughes and myself, we own close to 40% of the total shares of the company, most of it being in OP units. So it's not in the float, but you know, in terms of our markets, they're extremely highly favorable fundamentals, not just from a standpoint of the economic growth that we talked about, but we're also seeing it from a standpoint of renter migration coming in from all over the states that are along the coast. Tremendous amount of population growth, and it's wonderful. They've done a study, and the population growth that's coming in is the profile that one would want. You've got 50% they've noted as being having 4 years of a college education. If you look at our portfolio, we do have embedded growth opportunities, and we have certainly executed on a very proven growth strategy. As we have, what Dan had mentioned is we have bought over $880 million of property over the last 2 years after selling about $550 million of assets. And right now we have about $250 million of dry powder that we have available so to purchase. Please turn with me to slide 9. And of course, we are an internalized management platform. We came into the REIT that way, and no one's paying anything for this platform. We do look to fully exploit this opportunity as we go forward and looking for opportunities for the REIT to continue to grow. But with that being said, not only were we founded in 1956, but we are rated as one of the best places to work in the state of Arkansas for 4 years running, which speaks volumes to the type of company that we are. We have an excellent online reputational assessment scoring. And what that really means is that residents score the property owners of REITs in the United States, and BSR has been in the top 5 of the ORA scoring ever since we've been listed at the TSX, which we're very proud of. We've been as high as 2 and as low as 5, but we're right in the middle right now. And we continue to try to work that score and having our residents be very satisfied. We do have a very low employee turnover, which also speaks volumes again about the training that we do for our employees, as it's about 50% of the national average. If you would please turn with me to slide 11. Just to give you some context, we believe that we are in one of the most top performing sectors of real estate. As for the last 20 years, from 1999 to 2019, the multifamily sector was the highest performing sector, outperforming the next one, which is industrial, by 12.4% to 10.4% on an annualized basis, and that includes dividends. Please turn with me to slide 12. And this may give you a little bit a better context of just where we're situated. We're situated in the Sunbelt region, but in the mid-Sunbelt region of the United States. And this slide depicts that the Sunbelt has been consistently outperforming the rest of the coastal and the national markets in general, as the Sunbelt has achieved a 15% annualized return, as opposed to the coastal markets at 3% and the national average at 10%. And please turn to slide 13. A little bit over half of all the BSR cohort, who are middle income residents, they are of the millennial class. And the millennials, their ages of between 21 and 34 years old. They like the flexibility. They love the lifestyle. As I was talking about, the amenities that we offer in our properties, to enjoy those amenities. And, you know, when you think about this particular cohort, this group, they do have a more of a propensity to rent because of the high debt profile that they have. They have taken on so much debt for their education debt, going from about $500 billion back in the early part of the early 2000s to about 1.5 trillion today. And so Dan's going to talk a little bit more about our quality portfolio and the embedded growth opportunities. So Dan, would you please go?
Sure. Thanks, John. I'm looking at page 15 and for everyone who's following along. This is going to identify we're just going to talk about some of the key ingredients to what BSR looks at in our markets. The key ingredients of apartment investment are going to be population growth, personal income, and total employment. So when we think about population growth first, we look at population growth in our markets, and it's triple the pace of the national average. It's well in excess of the gateway markets in the last, let's say, decade or so. And let's highlight one market in particular that we're invested in, and that's Austin, Texas, where we've seen population increases in excess of 29% since 2010. Now that's 6.5% higher than the second fastest growing city in the nation, which would be Raleigh, North Carolina. The other two Texas markets, Houston and Dallas, are in the top 5 to top 3 year over year in population growth and also in job growth. Now, when we look at personal income, and for everyone following along, I'm looking at page 18 of the deck. What we want to highlight here is it's not the money you make, it's what you do with it. In our markets, if as depicted on slide 18, the resident spends on average about 20% of their personal take-home income on rent. You compare that to the gateway markets, where they spend about 40%, or the national average of 27.2%. So when we look at what our customer profile spends their money on, we see a whole lot of upside in markets that are extremely popular. And by popular, again, I'll highlight Austin, Texas, which again this year for the 4th year in a row has been named by US News and World Report as the most desirable or the best place to live in the United States. So in that respect, we want to talk about a little bit about what we own in these markets. And I'm looking at, call it slide 19. What we're going to acquire in these markets is generally going to be a newly constructed asset, or a recently constructed asset. These are located on large swaths of land. Oftentimes they look like large mansions, or what we refer to in the United States as garden style or mansion development. The majority of our residents have covered parking or garages. There are amenities throughout our properties that include 2-story workout facilities, dog parks, multiple swimming pools for each property. I think we still might have a couple of fishing lakes attached to the back of some of our assets as well. The average rent for our assets is around $1,100 to $1,200 a month. And the majority of them are located, I'm looking at slide 20, the majority of them are located in Texas. So our 3 core markets are going to be Austin, Dallas, and Houston. Those are our 3 Texas markets. Our 4th market, Oklahoma City, it's not as, I would say it's not as much of a household name as Austin and Dallas or Houston would be, but I can tell you it's a perfect example. Richard Florida, a reputable author, wrote a book about Oklahoma City. It's called The Next American City, where he talks about how what Oklahoma City did in transforming itself in the early 2000s by financing infrastructure growth and better schools through sales tax was forward thinking as opposed to real estate tax increases. The second thing they did in the early 2000s was they brought the Oklahoma City Thunder, a professional sports franchise, to the market. What we're seeing and what we have seen for the past 15 years in OKC is just massive asset accretion. We've seen above average population growth, job creation, and a nice hub for what we would refer to as a North Dallas market of around 1.5 million people in Oklahoma City. With that, moving on to slide 21, when we look at the average market rent per square foot in our primary markets, you can see that from 14 to 19, you have compound annual growth rates of ranging between 1.7 and 4%, Dallas, Fort Worth being the highest. One thing I want to highlight here is that each of our markets today, this quarter, are sitting in historic peak effective rent growth. So to say that again, Each of our 4 markets in the second quarter of 21 have rent increases higher than they have than their entire history. And if I wanted to call out one in particular, I would say Austin is currently experiencing a projected 18.8% market rent growth through year-end 2022, according to RealPage and CBRE. This is a multifamily market in the United States in the Sunbelt that is absolutely on fire, not physically. It's not hot. It's not hot down here yet, but metaphorically, we are absolutely just we can't buy enough properties. We can't lease them fast enough at high enough rates. We're really happy and proud at what we did. Now, if I'm looking at slide 24 before I hand it over to Susie to discuss the balance sheet, these 17 properties are indicative of assets that we've acquired since our IPO in 2019. As I said, most all of them are newer construction. And are located in our 3 core Texas markets. And as John highlighted and is highlighted on slide 25, since the IPO, we've acquired roughly $882 million of assets balanced against about $620 million of dispositions. So with that, I'll direct everyone's attention to slide 28. And Susie, would you like to provide the financial review?
Absolutely. Thank you, Dan. And I'll go quickly so we can have some time for questions. I think the key here for Q1 to note is we have revenue growth, same community revenue growth, and same community NOI growth that outperformed our Sunbelt peers. This is impressive because, as we mentioned earlier, we've sold 75% of our portfolio, while at the same time continue to have top performance with the communities that remain in the portfolio. What I do want to point out is you'll see the decline in FFO and AFFO. Nobody panic. All this is a result of timing. We've sold more assets basically than we bought. So we sold 12 assets in the fourth quarter of 2020 and didn't purchase again until the last day of the month at Q1. Hence the absence of NOI for the assets sold versus when we purchased again, starting at the end of Q1 and then again in Q2. The payout ratio is the same issue. That will go back to a more normalized 80-ish% once we finish our recycling program, which has to do with spending our dry powder, which I'll talk about in a second. Fourth quarter, looking at the year, it's pretty much the same story. Revenue for same community basis is up, NOI is up as well, and FFO and AFFO are slightly down due to the timing of when we purchased versus when we bought. Moving on to slide 30, here you'll see our debt to GBV is 44.3%. We're comfortable going up to 55% if we have the right opportunity. Our weighted average term to maturity is 7 years. And of course, our weighted average interest rate right now is 3.6%. Key here, though, is we have total acquisition capacity of $287 million, of which we expect to spend a good portion of before the end of the year. Another thing I'd like to point out right now is that BSR continues to trade at a discount to NAV. And our NAV continues to go up. So we announced at the end of Q1 that our NAV was up 8.6%, I think, over the prior year. We expect our NAV to continue to go up throughout the year because of the impressive growth we're seeing in our markets. Our NOI keeps going up based on what Dan has just told you. And yet we're still trading at a discount, and our US peers that are in the Sunbelt trade at premiums. Our Canadian multifamily peers are certainly trading right at NAV. So we look to be the only REIT on sale right now, and we're located in some of the best growth markets in the US. So I think this is a very compelling story if you're looking for a deal right now, to definitely take a look at BSR. Thanks. And with that, why don't we turn it back to David for some questions?
Great. Thanks, John, Susie, and Dan. So we will rush through questions a little bit, but I do want to touch just on your last point, because the first question may relate to that. Given that the U.S. peers are all trading at premiums to NAV, we have a question asking, are you planning a U.S. listing, or is there a U.S. listing planned at any point in your future? What would it take to get there?
David, this is John, and no, not in the near term. We really would like to, we know that why we went public in Canada was the great support we've had both on the buy and sell side. We've seen from all the case studies of even Milestone that had gone public back in 2012. They went private in 2017 after having done 9 follow-ons, and they went public at $10 a share Canadian and went private around $22, a little bit north of that when they went private. And we sense that it's taken a little bit of time for our Canadian investor to understand BSR and our story, but we do believe that we are getting more traction and understanding with what's been going on as we're doing this with you today. And we really do appreciate you having us on to be able to tell our story. But it really does cost a tremendous amount of additional dollars to go have a dual listing. And for our small size, it really doesn't make sense. We made the decision to go public on the TSX for that reason.
And along the same vein of the kind of differences in the Canadian operating environment and the US, and given the theme of our conference is the post-COVID economic recovery and rise in inflation at the US, can you maybe speak to your ability to very rapidly pass on any inflationary growth in rents as opposed to being hindered by rent control?
First of all, I'll say that we have had, definitely some costs that have been embedded into new construction, and it has made the dynamic of there being a lesser amount of new product that is being forecast for being built for obvious reasons. But you've had a tremendous amount of demand. Our teams have told us that they've never seen more traffic than what we're seeing today. We have our occupancy is resting right at 95.6% today. And for BSR, that's very strong. And that's about where we would like to see it, between 95 and 96%, wholeheartedly, just because that means you're pricing your units correctly. And as I was mentioning earlier, we've increased rents 8%. So in terms of the new leases, and 3% on renewals. And when you look at the dynamic of what's going on with the supply and demand, we're not concerned about, how much inflation is, everyone's talking between 2 to 4% inflation, and that it may be transitory. The bond markets have not been reflecting long-term inflation. So at this point, BSR, we're anticipating that we are going to see a spike of inflation in the market. We believe is anticipating that, but we are seeing some excise demand coming in for our product at this point in time, just as many of the aggregators and data aggregators have forecast. But I'll tell you that from a standpoint of renter migration, we've never seen as strong of a situation that we're going through today. And it may be because the pandemic helped promote additional renter migration, but we've consistently have seen this over the years, but not to the degree that we're seeing it today.
Yeah. And David, I think you asked about, this is important. We don't have rent control in our market, so we're able to reprice our leases at market. Each lease is between 10 and 12 months roughly. So at least once a year, we have a chance to mark a lease up to market. And of course, we turn our apartments much faster as well than in Canada. Turnover on average in multifamily housing is 50% in the US.
Yeah, and then that's a very, very important differentiator, I think, between the US, particularly the markets you are in, versus the Canadian, where the Canadian REITs are largely positioned. And maybe just another real quick one under the wire here. You've obviously been very successful in cycling out of non-core assets and into higher growth markets since your IPO. Going forward, what does the acquisition environment look like in terms of cap rates? And what's your acquisition outlook for the rest of the year?
Dan?
Yeah, sure, David. So the acquisition market right now is, I can't think of a great analogy other than just say it's hand-to-hand combat. Asset values, we haven't seen this type of appreciation, rapid appreciation in asset values in quite some time, if not ever. Now, with that said, BSR has a strategic advantage in the markets we serve, and that is that we can act quickly, and we are very liquid with our offers. So once we identify an asset that we like, we can execute upon it and acquire it and put it in, bring it up, put the BSR flag in front of it within, I'll say, less than 25 to 30 days. That gives us a little bit of a competitive advantage against our competitors in this market that are using oftentimes agency, that is Fannie Mae or Freddie Mac debt in order to acquire the type of assets that we acquire. The timeline for those executions takes 60 to 90 days. So with that said, cap rates have never been lower. And for good reason. I mean, I think we started the conversation today by talking about how rent increases have never been higher. It's an attractive asset class located in markets that are some of the fastest growing markets in the United States that have been reopened for some time now. As it goes forward I would say between now and the end of the year, we've guided that we're looking to acquire about $200 to $250 million of assets. That equates to about 5 to 6 properties for us. We really see no impediment to filling the pipeline between now and the end of the year, if not sooner. It's just remaining active in our markets. As a matter of fact, we're all here at the office today. Our acquisition team is in Austin and Houston right now doing exactly that, with walking sites, looking at potential opportunities.
Okay, fantastic. John, Susie, Dan, on behalf of Echelon and everyone in attendance, I'd like to thank you for making the time to present to us today. And we look forward to following the story going forward. BSR trades on the TSX ticker HOM.U.